So, good morning, everybody. And first of all, I want to wish everybody a very happy new year and a healthy one. And I hope everyone has a productive and a great new year. And stay safe. And I want to finish up chapter 13 here. And where we left off was I was looking at capital structure theory. And here's an example here from this company, Cook. And it's very easy to see what they did. Basically, right here. Here's their current capital structure. They didn't issue any bonds. Okay, is everyone clear about that? There's no bonds, no debt, and they have $500,000 in stock out. 25,000 shares at $20 a share. So this is their total assets. All right, this is their total assets. If you add those up, right? Okay, so what they want to start showing here is different capital structures. There's alternative debt ratios that Cook Company could use. Okay, so if we look here, this is what we just looked at on the previous slide. Everyone see that zero, and here's the 500,000 in equity, no debt, and it's $25 a share, right? And I mean, it's 25 shares, right? Times 3 zeros here, so it's 25,000 shares, right? So if we look here, 25,000 at 20. So this is the first line in that table. Now they make a statement. They say, what about if we have 10% in bonds instead of zero? So that would be 10% of 500,000 would be 50,000. So the total remains at 500. So that leaves equity of 450,000. So now we just reduce the number of shares we have, right, accordingly, because we have some debt. And we could keep doing that. 20% would give us 100, but this always adds up to 500, the total assets. Everyone sees that, right? Everyone sees that, right? So basically, they have different debt ratios here. And they make a good point here. Because the company has no current liabilities, its total assets equals its total capital, right? When it comes to net working capital, right? Okay, so everyone should be clear on this table. If you're not, email me. But they're just showing, what about if we change the amount of debt the company holds? Okay. All right, now here's one issue. Again, here's now the level of debt. But of course, if you have debt and take on more debt, you got to pay more interest, right? So here's the interest that they're paying on the debt, starting with zero, of course, because they didn't have any here. And you'll notice the interest rate goes up the more debt you take, right? The more debt you have, the more you're going to pay. So by the time they have 60% debt, they're going to pay like 16.5% interest, right? The analyst is going to say, you got too much debt, you got to pay more interest. So here's the calculation of earnings per share. Here is the debt ratio of 0. And here is the earnings before interest and taxes, theoretical, from table, I guess, 13.9, right? 0, and this is all in your book, by the way. 100, 200, right? 1,000. And, of course, there's no interest because we just said debt ratio is 0. And taxes are 40%. And so here's your net profit after taxes, right? So the earnings per share is 25,000 shares, and it comes out to the earnings divided by 20,000 shares. It comes out to 240 and 480, depending on the probability of this EBIT happening. All right, there's a probability associated. Let's say they're saying, well, there's a 25% chance of 0, a 50% chance of 100, and a 25% of 200. Now, some of these numbers here, you should have been familiar with. You should have seen expected return. So if I take the earnings per share and multiply it by the probabilities and then add them up, this would be my expected earnings per share. And all these calculations were done in 330, and you could review these on the slides because I think I gave you all the slide chapters earlier. As I mentioned, I used the same book for 330 and 365. So you should be able to figure out how to calculate that. In fact, to get the coefficient of variation, you just take the standard deviation and divide it by the expected earnings per share here. And you should get 0.71. You should try that. All right, now here's the same calculation with a debt ratio of 30%. So here's the interest, right? Here's the interest. And again, the probabilities are the same, right? And the only thing that will change is the amount of interest you're going to pay, and then the taxes on this. And, you go through this calculation again. So they're just changing the debt ratios in each of these tables. And here it is at 60%, right? So if you go back, you'll notice the earnings per share are going up because of leverage, depending on what debt we're taking, right? Everyone see that? As the debt ratio goes up, this is going up, right? And here is a table showing that all the calculations for all the different capital structures. And basically, here's the earnings per share. Now, there's something interesting. So you can see the standard deviations are constantly going up. And so is the coefficient of variation, right? So all those calculations, and you could do these with a Microsoft Excel spreadsheet. Okay. All right, so here's the probability distribution, right? And here's the debt ratio of 0, right? And you can see the earnings per share, the expected return is $2.40, and here it is at $3.03. Notice how this is more spread out, the blue curve with the debt ratio is 60, telling you that there's more risk. Remember that? The larger the spread on the standard deviation of the curve, of the normal distribution, they're telling you there's more risk involved. And of course, there's more risk when you take more debt, right? All right, so this is a real important curve here. Notice here's the expected earnings per share. And as soon as I hit my earnings per share is at a debt ratio of 50, my earnings per share is $3.18, right? And then it begins to drop off. So this is my optimum earnings per share. Let me go back because I wanted to make sure I didn't. Oh, you notice right here, I kind of missed telling you that. I'm sorry about that. Notice here how this dropped off. So your maximize is 318, and then you dropped off at 60. So you notice how this is coming down now. That reflects this curve right here. So you'll notice how your financial risk and your business risk is constant here, right? But your financial risk is going up, right? So you maximize at the 60% there. All right. So some of the things that are important is what's known as asymmetric information. And basically what that simply is the people running the company have more information on the insiders than you do. And you not getting all the information, all right? So you should kind of go over some of these terms. They're pretty easy to read. All right, so what's then becomes the optimal capital structure here. And the optimal capital structure, and here's the value of the firm, right? And it's important, this point here, right? Because the value of the firm equals the present value of its future cash flows, it follows that the value of the firm is maximized when the cost of capital is minimized, right? You want to minimize the cost of capital. So here is EBIT, and here's your cost of capital, right? Weighted average cost. You want to minimize this. So this is simply EBIT times 1 minus your tax rate is simply called net operating profit after taxes, and that's how you calculate that, right? But you minimize your the value of the firm. You minimize your rate, your capital, cost of capital, and you max. So obviously, when this gets smaller, this will get larger, right? And that's should be obvious to everybody, right? So here's the value of the firm, and here's the debt to total assets. And you'll notice as the debt picks up, the value of the firm begins to drop off, right? Everyone sees that. And here's the different returns from equity, from stock, and debt, right? Here's the bonds, here's the stocks, and here's the weighted average of both of those. Everyone see that? All right. So I think from that point on, we should be okay. I'm not gonna hold anybody responsible for. So this is the last slide right here that you'll be responsible for. Okay, 73, and the rest of these you can go over, but you won't be tested on these. It gets a little too complicated. Alrighty. So everybody have a good New Year, and take care of yourselves. See you soon.